How's it going all? Welcome back to the channel. So in this video, I will be sharing how you can earn consistent passive income on your stocks by selling covered calls. This is a very popular option strategy that is used by many institutional and retail investors. Finally, I'll even show you how to sell your own covered calls on Fidelity to earn that sweet premium income. So without further ado, let's dive right in. At its core, a covered call strategy involves an investor buying or holding shares of a stock and selling call options. This is a contract where an investor agrees to sell 100 shares at a predetermined strike price within a given time frame. In return, they receive a premium paid upfront that they can keep regardless of the outcome of the contract. So as an example, let's say that you own 100 shares of Apple that are currently trading at $155 each. You are comfortable selling your shares, so you decide to sell a covered call with a strike price of $162.50, expiring 4 weeks from today. In return, you will receive a juicy $205 premium. Regardless of the option's outcome, you will pocket this money as guaranteed income. Let's say in scenario 1 that Apple's stock price doesn't really change much in February. It goes up and it goes down, but it never crosses the strike price of $162.50. If the stock remains below the stock price, the option is considered out of the money and will expire worthless. On March 3rd, you will keep your 100 shares of Apple, but you also get to keep that $205 premium. And in this scenario, you actually beat a traditional buy and hold strategy. In both cases, you started out with 100 Apple shares, but by using covered calls, you earned an additional $205 on top of keeping those 100 shares. You actually generated an additional 1.3% return in 4 weeks through these option premiums. That's an amazing return already, and I could sell these options every single month. It's starting to sound like a get-rich-quick scheme, right? Super profitable, no risks, there's no catch, right? Well, there is a scenario too. Let's say that Apple's latest earnings report is unbelievably good and the stock price rockets up to $175. Well, because we have now exceeded the strike price, a buyer can exercise the contract and you can be assigned. If that happens, you must sell 100 shares at the predetermined $162.50 strike price. You will still get to keep that $205 premium, but you can't sell your shares anymore at the current $175 valuation. In other words, you traded your upside potential for that option premium. That said, it's not all that bad though. Remember that you started out with 100 Apple shares worth $15,500 in total. You sold those shares for $16,250 and you got an additional $205 premium. That trade still netted you a profit of $955. Not bad, and it's actually pretty good. But in this scenario too, you did lose to a traditional buy and hold strategy. If you had held your shares without selling covered calls, you could have 100 shares currently worth $17,500. So if you sold now, you'd have a profit of $2,000 instead. So at the end of the day, covered calls are not this magical money printer. You are selling the upside potential on your stocks in exchange for regular income through option premiums. Therefore, covered calls are ideal for investors who believe the underlying stock price will not move that much over the short term. They are comfortable holding shares for a long time, but they also want to generate some additional income and lower their average cost basis. In other words, most option sellers want their stock to remain consistent, but still want to pocket money on a regular basis. However, a covered call is only effective if the underlying stock is stable. Suppose that you owned a stock like Carvana that is down 90% over the last year. Covered calls, simply put, will not protect much against drops in the stock price. Therefore, this strategy doesn't work as well if the stock has high volatility. And although covered calls are widely considered to be a low-risk option strategy, you do still need permission in order to trade options. There are many other complex option strategies out there, and there are, unfortunately, a lot of ways that you can lose all of your money, so please be careful. So today, we'll show you how to sell covered calls on Fidelity. Now, if you don't have access to options already, you can hover over to the Products tab and select Options. You can then click on Start Trading Options and then Apply or open a new brokerage account. Now, if you don't have a Fidelity account already, definitely use the promo code Fidelity100 to earn an additional $100 cash bonus when you open a new account. But if you are approved already, you can hover over to News and Research and select Options. This shows you what we call an option chain. You can type in any symbol that you would like to see the options for. For me, I own 100 shares of the Spider S&P 500 ETF, and I plan to sell covered calls to earn some additional income. So I'll type in SPY for the ticker symbol. I also personally prefer monthly call options because I have a longer expiration date, so I can take advantage of higher strike prices. I also plan to sell out of the money calls, so I'll put the strike price for all instead of the 10 closest ones, and then I will click Apply. And here you can see all of the contracts for March 3rd, 2023. The one that I'll go for is the strike price of $430. The bid price is 1.55 per share. Because each contract controls 100 shares, I'm expecting a premium of about $155. Now, one of the most important variables that I look for is delta. Delta is a variable that estimates how much an option's value changes given price movement of the underlying security, but because options are priced efficiently, it's also relatively proportional to the likelihood that the option gets assigned. So in this example, the $430 strike price has a delta of 0.174. This means that I have a roughly 17.4% chance that the contract expires in the money and I will have to sell 100 shares. Personally though, I don't think that the S&P 500 is going to increase 4.5% within a single month, but I could be totally wrong, to be fair. So personally, I aim for 4 weeks until expiration with a delta between 0.1 and 0.2, so this one works perfectly fine for me. So once you find the right strike price and the right expiration date for your stock, you can then select the bid price under the call section. For covered calls, your action is referred to as sell to open. In other words, you're selling a call and opening a contract. The quantity refers to the number of contracts that you want to sell. Keep in mind that each contract controls 100 shares, so if I want to sell covered calls on 100 shares, the quantity is 1. If it's 200 shares, then the quantity is 2. And moving on, you can see that I am selling a covered call and opening one contract. The expiration date is March 3rd and the strike price is $430. The current price is actually closer to $1.60, so I switched to market order since SPY already has a lot of option liquidity. Time of force is day because I want my order to be fulfilled immediately. Now, it looks like I'm trading on margin, but I don't personally prefer that, at least in the traditional sense. I'm actually transferring all of my accounts from Charles Schwab onto Fidelity. So unfortunately, right now, for this in-between period, everything in my account shows up as margin, but I'm not paying any interest on this account. So before anyone comments, don't worry, very, very safe investing. But anyways, you can see here that the maximum gain for this trade is my option premium of $160 or 1.6 times 100 shares. My maximum loss is technically unlimited because my underlying stock could decrease to 0. But that's practically impossible since it tracks the S&P 500 index and the US would basically have to collapse for my money to completely disappear. That said, you can also see here that the break-even price is $431.60 when you factor in the strike price and the option premium. And here we go back to those two scenarios. If SPY goes past my break-even price of $431.60, I would have actually been better off just holding on to my shares. Now, if SPY remains below $431.60 for the entire duration of the contract, I will have actually profited by selling covered calls. Each broker does charge a different commission for opening and closing contracts though. The standard for full service platforms like Fidelity is 65 cents, so I'm actually getting $159.35 premium instead of that flat 160. Other brokers have no fee commissions like Robinhood, and some other ones might have $1 option contract fees. Now, if you feel comfortable with your option, you can then select place order. Once it's fulfilled, it'll show up under the positions tab for you to track its progress. I currently have a loss of 69 cents, but that's mostly due to commission. But most importantly, I earned a $160 premium that I can use to buy other stocks or ETFs. Now, I hope that wasn't too complex, and I hope that was a decent explanation to how covered calls work and how you can use them to earn some passive income for your stocks. At the end of the day, if you have any questions or need some clarification, please let me know down in the comments and I'll be happy to respond. Have a great rest of your day and take care. Have a good one.